Welcome to this deep dive, comparing and contrasting Realty Income, ticker symbol O, and National Retail Properties, ticker symbol NNN.
Okay.
If you're listening, you're likely interested in understanding their investment strategies,
Right.
financial health, and ultimately, which might be a better fit for your portfolio, we'll be exploring their dividends, dividend growth, payment schedules, capital growth,
Okay.
property types, regions, and more, drawing insights from their 2023 annual reports.
Got it.
Let's start by examining their dividends.
Sure.
Can you give me an overview of the dividend payouts for both O and NNN in 2023?
Yeah, so Realty Income distributed a total of $3.0511 per share to its stockholders in 2023.
Okay.
This payout represents 76.3% of their AFFO, or adjusted funds from operations, a key metric that shows the cash flow available to shareholders
I see.
after accounting for recurring capital expenditures. National Retail Properties focused on balancing substantial dividend payouts with maintaining its REIT status, which requires distributing at least 90% of its taxable income, paid out $404.5 million in dividends in 2023.
How does Realty Income's status as a dividend aristocrat impact its dividend strategy, especially compared to NN?
Realty Income's dividend aristocrat status underscores its commitment to consistent dividend growth, an attractive feature for income-focused investors.
Right.
They've achieved a compound average annual dividend growth rate of 4.3% since 1994.
Okay.
While NNN is not a dividend aristocrat,
Right.
it prioritizes consistent payouts while adhering to REIT requirements.
Got it.
This difference highlights the varying approaches these companies take towards balancing growth and shareholder returns.
Both Realty Income and NNN are known for their monthly dividend payments.
Yeah.
What can you tell me about their dividend growth and how these compare?
Well, Realty Income, known as the monthly dividend company, takes pride in its dependable monthly dividends and consistent growth. NNN also pays dividends monthly and boasts 34 consecutive years of dividend increases,
Wow.
the third longest streak of all REITs.
Interesting.
However, it's crucial to consider that while Realty Income showcases steady growth,
Right.
NNN's increases have fluctuated over its 34-year streak.
I see.
This raises a question about future performance. Can NN maintain this streak?
Okay.
And can Realty Income sustain its consistent growth rate?
Both companies seem to recognize the appeal of monthly dividends for investors seeking regular income.
Yeah.
Let's delve deeper into their investment strategies and how they drive capital growth.
Sure.
What are the key elements of Realty Income's investment approach?
So Realty Income focuses on acquiring properties with long-term net lease agreements. Think of it like renting out your house, but making the tenant responsible for all the repairs, property taxes, and even the insurance.
Right.
That's less hassle for the landlord,
Sure.
which is what these REITs are aiming for.
Makes sense.
They seek tenants with reliable cash flow and diverse revenue streams,
Got it.
minimizing their exposure to rent fluctuations and defaults.
Right.
They hone in on businesses in the service, non-discretionary,
Okay.
and low price point retail sectors.
Oh,
Think about your last shopping trip.
okay.
Did you grab a coffee at 7-Eleven,
Huh?
pick up prescriptions at Walgreens,
Sure.
or maybe snag some deals at Dollar General?
Sure.
These everyday businesses are the backbone of Realty Income's portfolio.
Interesting.
They're resilient to economic downturns and shifts in consumer spending habits.
Realty Income's approach sounds very deliberate in mitigating risk and ensuring steady income. What about NNN? Could you elaborate on their investment philosophy and the factors they consider when choosing properties and tenants?
So NNN shares a similar focus on disciplined underwriting,
Okay.
but they emphasize building strong relationships with their tenants.
I see.
They invest primarily in freestanding, single-tenant net lease properties across various industries,
Right.
aiming for long-term leases with renewal options. This allows them to build more personalized relationships and closely monitor each tenant's performance.
Yeah.
They place a high premium on tenant creditworthiness,
Sure.
conducting thorough evaluations of potential tenants' financial stability.
Got it.
They're like that friend who always pays their bills on time and has a healthy emergency fund.
Okay.
You might not get rich quick with them,
Yeah.
but, they'll be around for the long haul.
So both O and NNN prioritize the security of net lease properties and the quality of their tenants.
Yeah.
However, Realty Income has a broader international presence and a distinct focus on retail properties, while NNN emphasizes specific relationships and single-tenant structures.
Right.
What are the potential risks and rewards associated with each of these strategies?
Well, Realty Income's international diversification offers potential for higher returns and exposure to different markets.
Okay.
But it also introduces complexities in managing properties across borders and navigating varying regulations.
Makes sense.
Their retail focus provides resilience against economic fluctuations, but exposes them to retail-specific risks,
It says.
like shifts in consumer preferences and e-commerce's growing dominance.
Okay.
NNN's emphasis on single-tenant properties and personalized relationships allows closer monitoring of tenant performance
Right.
and potential for stronger partnerships.
Mm.
However, this can concentrate risk if a key tenant faces difficulties.
I see.
Their diversified portfolio across various industries can help mitigate this risk.
Let's move on to the specifics of their property types and regional diversification.
Okay.
Can you break down the property type concentrations for both companies and highlight some key examples of their top tenants?
Realty Income's portfolio leans heavily towards retail properties, which comprise 81.8% of their holdings.
Okay.
Industrial properties follow with 12.7%.
Got it.
And they have smaller allocations to gaming and other categories.
Mm-hmm.
As we discussed, their top tenants include Dollar General, Walgreens, Dollar Tree, and 7-Eleven. NNN's portfolio, while also diversified, showcases a different composition.
Okay.
Their top lines of trade include convenience stores,
Sure.
experiential retail, and automotive services,
Got it.
with prominent tenants like 7-Eleven, Mr. Car Wash, Camping World, and Dave & Buster's.
It's interesting to see how their tenant profiles reflect their investment strategies.
Yeah,
Now, let's examine their regional diversification.
true.
Where are their properties primarily located, and what are the potential implications of regional economic trends on their portfolios?
For NNN, 41% of their annual base rent comes from properties in Texas, Florida,
Okay.
Illinois, Ohio, and Georgia.
Right.
This concentration makes them susceptible to economic downturns or regulatory changes affecting those specific regions.
I see.
Realty Income, on the other hand, doesn't disclose regional breakdowns in their annual report, making it difficult to assess their exposure to regional economic trends. Transparency regarding regional allocation is definitely something investors should look for when comparing REITs.
Now let's shift our focus to their financial health and the risks associated with each company.
Okay.
Can you outline Realty Income's approach to financial management and the key metrics that indicate their financial stability?
Realty Income maintains an industry-leading balance sheet.
Okay.
Their fixed charge coverage ratio stands at a healthy 4.7x, and their net debt to annualized pro forma adjusted EBITDA is 5.5x.
Okay.
These metrics indicate their strong ability to meet their financial obligations.
I see.
They access capital through diverse channels, including common stock, preferred stock, and debt offerings, demonstrating flexibility in managing their finances.
Those are certainly strong indicators of financial health.
Yeah.
But even financially sound companies face risks.
Right.
What are some of the key risk factors Realty Income acknowledges in its annual report, and how might these impact their future performance?
Realty Income acknowledges cybersecurity threats, tenant bankruptcies, and economic downturns as key concerns. Cybersecurity breaches could disrupt their operations, compromise sensitive data, and damage their reputation.
Makes sense.
Tenant bankruptcies could lead to lease terminations, lost rental income, and costs associated with releasing or selling properties.
Okay.
Broad economic downturns could negatively impact tenant performance across various sectors, leading to decreased occupancy rates and rental income.
These are all valid concerns that investors need to be aware of.
Yeah.
Now let's delve into NNN's financial standing.
Okay.
How does their approach to financial management compare to Realty Income's, and what metrics highlight their financial strength?
Well, NNN also emphasizes a conservative approach to managing its balance sheet.
Got it.
They haven't required additional capital for operations, showcasing their ability to generate sufficient cash flow to cover expenses. Their strong occupancy rate, averaging 98% over the past 25 years, further demonstrates their financial stability and ability to attract and retain tenants.
That's an impressive occupancy rate, speaking volumes about their ability to manage their properties and maintain strong tenant relationships.
Right.
But, as we discussed with Realty Income, every business faces potential risks. What are the key risk factors NNN identifies in its annual report?
So NNN acknowledges a range of potential risks. They recognize the possibility of tenant bankruptcies,
Right.
which is particularly impactful given their focus on single-tenant properties.
I see.
Broader economic conditions impacting specific regions or industries could also affect tenant performance and their rental income stream. Cybersecurity threats, much like with Realty Income,
Right.
remain a concern.
Okay.
Additionally, NNN highlights interest rate fluctuations as a potential risk factor,
Sure.
as rising rates could increase their borrowing costs and impact profitability.
This deep dive has given us a lot to consider,
Yeah.
especially regarding the risks both companies face. Let's synthesize this information and discuss what it means for potential investors.
Okay.
Hey there, it's me, the guy who has the thankless job of making the ask. Please like and subscribe to the channel. It really helps us bring you more and better content. We need to know what helps you so we can provide more of it. Thank you.
So what does all of this mean for potential investors trying to decide between Realty Income and NNN?
Well, for investors, the choice between Realty Income and NNN hinges on individual investment goals,
Okay.
risk tolerance, and due diligence.
Right.
Let's start with their dividend strategies.
Okay.
Realty Income's dividend aristocrat status and consistent growth make it attractive for investors seeking predictable and growing income. Their focus on service, non-discretionary, and low price point retail tenants, coupled with their international diversification, aims to provide resilience against economic fluctuations.
Right.
However, their exposure to retail-specific risks and the complexities of managing properties across borders warrant careful consideration.
And what should investors consider about NNN's dividend strategy?
NNN, while not a dividend aristocrat,
Right.
boasts an impressive 34-year streak of dividend increases. Their emphasis on building relationships with single-tenant operators across diverse industries aims to generate stable rental income.
Okay.
Their concentration in specific regions and reliance on individual tenant performance, however, require close attention to regional economic trends and tenant-specific risks.
So both companies offer compelling options for income-focused investors, but with nuances to consider.
Yeah.
What other factors should investors evaluate when comparing these two REITs?
Beyond dividends, investors should carefully assess each company's financial health, risk management practices, and portfolio composition, Realty Income's industry-leading balance sheet,
Right.
diverse capital access,
Sure.
and proactive risk mitigation efforts suggest a strong financial foundation.
Okay.
NNN's conservative balance sheet,
Got it.
consistent profitability, and long-standing relationships with tenants also point to financial stability
Right.
by examining their property portfolios.
Okay.
Investors can compare tenant profiles, industry diversification, structures,
Right.
and regional allocation to understand how each company manages risk and generates returns.
It sounds like a thorough due diligence process is essential.
Yeah.
Can you elaborate on the specific financial metrics investors should pay close attention to when evaluating these REITs?
Certainly.
Okay.
Key metrics include occupancy rates,
Okay.
rent escalations,
Mm-hmm.
leverage ratios,
Right.
debt maturity profiles,
Got it.
and coverage ratios.
Sure.
These metrics provide insights into each company's ability to generate cash flow,
Okay.
meet financial obligations,
Mm-hmm.
manage risk,
Right.
and sustain dividend payouts.
Right.
Investors should also carefully review each company's annual report, paying attention to their management discussions and analysis of financial condition and results of operations.
Got it.
These sections offer valuable insights into the company's perspective on its performance
Yeah.
challenges and opportunities.
It's clear that a comprehensive analysis of both qualitative and quantitative factors is necessary.
Yeah. Right.
It's crucial to remember that no investment is without risk,
Yeah,
and thorough due diligence is paramount.
absolutely.
Our listeners should carefully examine each company's financials, property portfolios,
Right.
and risk factors outlined in their annual reports.
Yeah.
Don't hesitate to seek guidance from financial professionals to ensure your investment decisions align with your overall financial plan. Thank you for joining us on this in-depth exploration of Realty Income and national retail properties. We hope this deep dive has equipped you with valuable insights and sparked a curiosity to learn even more.